Welcome to the Private Lenders Podcast with your host from Hard Money Bankers, Jason Balin and Chris Haddon. This podcast is sponsored by hardmoneymastermind.com.
Hey everyone, Chris and Jason here, Private Lenders Podcast. Real quick story for you. It's not uncommon for people to reach out to us or, come into the mastermind, stuff like that. Mention the podcast as how they initially found us, and also tell us that after finding the podcast, they went back and listened to all the other 250 plus episodes, which is really motivating to us. Like when people tell us that, and it's happened a number of times, that just lets us know that this content is needed in the industry. And so I just wanted to tell that story. And quick ask, if you can forward this episode or another episode that you've listened to or watched before to somebody who you think would benefit from it, that would be super cool. We appreciate that a lot. Today, we're doing some crowd work, some community feedback type stuff. We're grabbing a few questions asked by members inside hardmoneymastermind.com on a couple different topics, and we are going to roll through them. It's Q&A day.
Yeah, some of our favorite type of content, because obviously if there's questions inside the mastermind group, it's something that our community, other lenders are interested in. So love to take a stab. And let's be honest, there's different answers to a lot of things depending on the types of deals that an individual lender wants to do. We tend to be a little bit more conservative. We want borrowers to bring a little bit more money into the deals, but that doesn't necessarily mean that's the only way or the best way. It's what works for us. So that's what we're trying to share. So yeah, let's go through some of these. And
all right, jumping in with a question from the other day from Robbie. Are there any borrower scorecards or sheets we could have on file for each of our borrowers as an internal scoring system? Curious to know if anyone else does that. So we don't do that, but I think it's a really good idea. Just initially thinking about that question and the things that could possibly go onto a scorecard for borrowers, and it's probably more stuff than you would think. Like, first, the obvious ones. How much cash on hand, right? And you can have like a scoring system, like 1 to 5 or whatever it might be, for how much liquid cash that you can document from them. Same for credit. That's an easy one too. Like, where does their credit fall in the range? And you get X amount of points for that. And also experience. How many deals have they done in the past? Any kind of real estate investment deals, give them a score on that. Other things too that you might be able to think of, like, do they own their primary residence, for example? Right? Like that's something that could potentially mean something. What else? What else jumps to mind that might go into factoring a borrower's score?
if you didn't say experience can be, how many deals they did, potentially, the construction budget compared to the size of the purchase price, right? That's a big one. Obviously, if the purchase price is 50 grand and the construction's 100 grand, there's a lot more risk than if the purchase price is 300 grand and that related to, like what you said, liquidity. I mean, really it's, you take, an underwriting metrics or an underwriting checklist, let's just say, and, you score everything based on that, the communication skills.
That's another good one. How responsive are they?
Yeah. How responsive are they? And, we all kind of do that. We might not do it officially, but we all do that. And as we're originating and underwriting and processing loans, we're all doing that. We're all determining what type of information we need from the borrowers and reviewing it and underwriting it. And we're talking to them on the phone, or we're meeting them in person, and we're eyeing them up, right? And again, it's not an official scorecard, but it's something similar. And I think that's important. And that's why, if you're a newer lender, you got to be meeting your borrowers, talking to them on the phone multiple times, verifying all the information and really just learning and kind of seeing what's up, because eventually, we can paint a picture of how a deal is going to work. Like Chris and I know going into deals, like, is this going to be an easy deal? Is this going to default? Are they going to make their monthly payments? Are they going to perform? Is it going to work? And that's just based off experience. So if you don't have this set up, just learn from it. Learn from what deals perform, learn from what deals don't perform, and why.
All right, jumping on to another one. This one is from Shelby Reed, a very active member of the mastermind. Okay, so this is kind of a sales and origination question. I'm going to read it off. So she says, how do you handle when potential borrowers come back to you after you have told them about your terms and what you charge? Okay, so basically they're shopping it and coming back to Shelby. Okay, and coming back and renegotiating with Shelby after she has quoted price. How would you handle that, Jay? What are your thoughts on competing on price based on them going out and getting another term sheet?
Well, so here's the thing. We don't negotiate or compete on price on anything. Everything's the same. And it wasn't like that at the beginning, but we learned like the one last thing I want to deal with is negotiating with borrowers and, hey, let's come down a half a point or do this or do that. Everything's the same. It's a 1-year loan, 12.99 and 3 points. Doesn't matter who calls us, when they call us, how many deals they've done with us. It's the same across the board. It's very, very consistent. And, we have scripting, through our process. We've done lots of videos related to, some scripting, for them to understand the value that we bring to the table. And hey, and I'll tell people up front, listen, I get it. You might be able to get something a little bit cheaper, but this is going to be a very easy transaction for you. I'm not going to micromanage you. You don't want us to micromanage you. And I don't want to micromanage you. So you bring a little bit more money into the deal, might be a little bit more expensive, but it's going to be an easy transaction. I've been lending for a long time. We're local. If you need anything, come to my office. We can go meet at the property. Keep it very, very simple. And, one of the things that, we chatted with Shelby about this, because I remember replying to this, was typically over like, I don't know, a point or half a point, you're probably not going to end up losing a good borrower that you've built a relationship with over a half a point. More than that, maybe. But again, you got to kind of hold the line to determine if, hey, do you want to be a cut rate lender? Do you want to lower your costs, your fees? Or do you just want to stay and be consistent across the board? And there's pros and cons of both. The problem is, as soon as you start lowering your fees and cutting your fees, you have that in your head that you can do that. And then all of a sudden you go from a 13-3 lender to a 12-3 lender or a 13-2 lender. And if that's where you want to be, well, I mean, you can be there. Like, that's up to you how you want to do it. It's a slippery slope by, reducing your fees and reducing your costs. So your job more of this is, as you're talking and communicating with a lot of people, put together your selling proposition and your script to hold your own of this, to hold the line on it. And, hopefully it works. And I mean, I'll tell you from experience that, we lost a borrower, or I shouldn't say lost. We don't do a deal. We don't do loans for a borrower. We did 100 loans for this borrower between 2000 and call it 10 and 2014, maybe 9 and 14, 5 or 6 years. We did 100 loans. It's a lot, but he got to a point where he wanted cheaper terms and higher leverage, and he was able to get it elsewhere. And that's okay. We lost that borrower, but we held our own, and that's where we wanted to be. I mean, we know what our profit margins are in these deals. Like, we don't want to lend at less money and make less money, because all of a sudden, great, I'm doing 30% more business, but I'm actually making the same amount of money, or I'm making less money by doing more deals because they're cheaper. That's not an ego play. Like, so that doesn't work for us. And on the other side, you can't be more aggressive, because if you're more aggressive, you'll lose money if a deal defaults. So that's not negotiable on that side either.
Yeah, I was just going to echo some of what you said about it being a slippery slope. Like, if you have it in your head that you can budge from your price, then man, because we've all felt that, and we've even dabbled with it a little bit with high loan amounts and stuff. But like, if you know that you can come down from 12.99 and 3 to 11.99 and 2, your brain's going to want to do that every time to help you win a deal. And the opposite is true as well. Like, when you're just so used to sticking to your guns and be like, yeah, that's just where we are. We do the same thing on everything. Then it's very easy to continue doing that. And also, I would also throw in that for a lot of people, that's just kind of a marketing problem, a deal flow problem. If you don't have enough leads, then you're trying to make every lead work somehow. And there's issues in that approach, both related to underwriting and to pricing. And the opposite is true as well. Like, if you have a bunch of leads coming today and somebody's like, oh, I'm only going to do it if you come down from 3 points to 2, then it's like, whatever, I got 10 other leads I got to work today. So not worried about it. So oftentimes this stuff is solved by marketing. All right, moving on to Harrison's question. What are everyone's credit requirements for your fix and flip loans? Do you have any tiers, hard cutoffs? What does that look like?
You want to jump in on that one, or you want me to start?
I can start on that.
Go
So we don't have any hard and fast credit numbers. Like we're not a bank. We don't have a lending matrix. But you know, one thing that we've said for a long time now, a lot of people in the mastermind are familiar with this, that there is a very high correlation of default between low credit scores and large construction jobs. For some reason, like if you can't manage your simple household finances, personal finances as an adult, then you're most likely not going to be able to manage something complex like a big construction job and a bunch of contractors. So that's not a hard and fast thing. And for the most part, like I think you chimed in with 680. This is approximately 680 as long as everything else checks out. We'll do the 65 LTV, and if lower, you'll consider doing the construction job just at a lower loan to value. Is that how you typically approach it?
Yep. Yeah.
Um,
Yeah. No, exactly. I mean, all of this works together, right? And I don't want this to indicate that credit is the least important, because it is very important, and we pull credit and we're very savvy about looking at it and making sure we make good risks, loan risks. But, collateral is the underlying collateral is the most important thing, right? Like that. And next to that is the character of the borrower. If the borrower is a crappy character, like you can't do a loan for them, even if they have good credit. And if the character of the borrower is, great, but they have low credit, maybe they just got out of a, divorce and whatever the case is, like, hey, it might be worth doing. But it's all taken into consideration. So there's no like bank metrics like, oh, you have a 679 credit, our requirement's 680. We can't do that deal. It falls under the same bucket. And also a credit score sometimes doesn't dictate what their credit history is, and vice versa. A lot of the times it's close, but there's times we've seen high credit because they don't have like many trade lines. And that's not great either, right? Like it doesn't tell us information. So, but like what Chris started with, a high construction project or a big construction project and low credit typically will fail. If a borrower has low credit, they don't have other means to get capital. They go over budget. They can't get Home Depot credit card. They can't get a line of credit. They can't get another loan. They can't refinance into a DSCR loan if they have low credit. So all those things have to be taken into consideration. And typically the rule of thumb, if there's any rule of thumb, is we'll go up to 80% of the purchase and 100% of construction with higher credit. And if the credit's lower, we'll make them bring more money to the table. And if it's really low, they're bringing a lot of money to the table. And there's exceptions to that rule as well. Like in the state of New Jersey, it's very hard to foreclose. It's challenging. We have to have a borrower that's going to perform, or we're not willing to do a deal in that particular state. There's just certain situations that if they don't have everything buttoned up and clean, it's challenging to do it.
Yeah, that's a good point too about credit score versus credit history, because they're both important. That score comes from somewhere, but at the same time, like get used to looking in their history. Like sometimes, it's not uncommon for real estate investors to use their credit cards to buy materials and stuff like that. So if they're running some high balances on revolving credit cards, that is going to bring their score down a lot, but it's not that bad as long as they're not like completely leveraged to the hilt. Like there are people who have never had a late payment and might only have a 640 because of revolving balances. So that's something to be aware of too, and something that we discuss with our business partners frequently, because a lot of people, if they're just doing a very cursory job of underwriting, will be like, oh, but he has 700 credit. It's like, okay, well, that's because he has one credit card and one student loan for $5,000, and that's it. And like very, very little history is not the same as saying, oh, he has 700 credit, right? So that's that on the credit and rehab stuff. Also, I want to cover Jay's question too, because this is one that a lot of lenders listening and watching have probably come across. How do you go about providing a loan, determining an ARV before ordering an appraisal in an area that you're not familiar with?
Yeah. So I remember Jay asking this question, and I gave him what our opinion is, and I'm sure other people differ to this, but I mean, typically we're only lending in areas locally that we know and that we're comfortable in. I don't like to lend outside.
That we have MLS.
Yeah.
Where we have MLS.
We live on MLS. We know we have resources. If I'm confused about a value or something, you can go drive over there. We can talk to a real estate agent. We can talk to other real estate investors that might know those areas. So we're big in lending in areas that we know locally. That being said, from time to time, we have done deals in areas as we might try to learn a different area. And there are opportunities in other areas. Just keep in mind that you got to be comfortable with it. The collateral, the local laws, everything. But whenever we do a deal in another area, we're going to reduce our exposure. We're going to reduce our LTV. And I'm going to talk about that in a second. But, at the beginning, we'll try to use some basic tools if you don't have MLS there, like Zillow or local tax records or, Google Street View to see what's up, potentially, call a real estate agent or another real estate investor there and say, hey, I'm looking to potentially lend in this area. If you were the real estate agent, what would you sell this for? If this was a beautifully renovated house, what do you think it's worth today? Right. We would, at some point, if the borrower moved forward and it wasn't an area that we really knew, we would order, some sort of third party CMA or broker's price opinion or some sort of valuation. But usually what we'll do related to scripting on this is I would say something like this, say, hey, honestly, like I don't lend in Rhode Island, right? Like if we got a deal there, I don't lend in Rhode Island. That being said, we might consider it, but we're going to be a little bit more conservative. We'll probably come in at 40 or 50% loan to value, based on your purchase price. So if you buy it for $200,000, we'll probably come in 75, 80, or 100. Is that something you can work with, right? And if they say that's something they can work with, that's great. Like, cool. Let's see if it's worth doing and making sense of it. If they say, oh, I'm looking for 100% financing or 80 or 90% financing, not doing that deal, right? It's just too high. It's too risky. There's too many unknowns. You won't do it. So first off, verbally communicate with the borrower to make sure, it's a deal that you potentially can do and they're bringing enough money. Second off, use some free online tools, to do it. Like online tools are great these days. You can get a lot of information off Zillow to determine some comps, local tax records. One of the things I like to search up is land records in certain states. So you just type in land records in certain states. You can see recorded deeds. You can see recorded mortgages and deeds of trust, all public record stuff. Again, there's more due diligence that's going to go along with this. But I would do that at the beginning. Then I would call real estate agents, real estate investors, maybe even get some third-party valuation. I know a guy that Chris and I have known for a long period of time, that his entire company does. Their entire business model is nationwide up to 50% LTV, right? Like that's just their model. That's how they've always been. They started right when we started. And they were in an area that was a very, very small market. They were comfortable lending in other areas. And they would do that, and they would fly out to every property. When the borrower locked up, if it was a $200,000 deal, they would charge whatever, $1,000 up front, some sort of fee, and they would pay for airfare, and you go out there for the day and you meet the borrower, and he did it. And I think that was smart. A little bit different model than we wanted to do because we wanted to stay local, but that was something. So, but there's enough free tools, and you just got to be comfortable with the deal over. But like if you're doing a deal out of your market, I would not go over 50 LTV. There's way too much stuff, and it's not necessarily just it's not necessarily just like not fully knowing the value of the property. It's what happens if you got to take over the property. What happens with foreclosure or filing judgments? Maybe you can't recoup. Maybe you can't recoup. Whatever it is, there's endless things. Just keep it at a low LTV if you're going to consider that.
All right, everyone, that is the pod for today. I hope you got some value from today's Q&A. If you haven't done so already, go check out hardmoneymastermind.com, and we'll see everyone here next time on the Private Lenders Podcast.
We hope you enjoyed this episode of the Private Lenders Podcast. Please note that the opinions stated by all the speakers on this show are only opinions and not intended for legal, financial, or accounting advice. please make sure to always check with your own legal, accounting, and financial professionals. If you enjoyed this episode of the Private Lenders Podcast, we'd appreciate it if you would spread the word. Make sure to check out hardmoneymastermind.com, the #1 free community for new and experienced private and hard money lenders.